Whichever way tomorrow's jobs numbers fall, it's going to be a leading indicator for the economy, the presidential race, and the stock market. So last month's 69,000 number caused a 212-point sell-off. 69,000 minus 212, not good. Here to see if anything's going to be better, we bring in macro strategy president David Goldman and Center for Economic and Policy Research co-director Dean Baker. Dean, start with you. We had a little stronger ADP number today, up 176,000. Jobless claims did fall a little more. And even though the ISM services was down, that's bad, the employment survey in there was up. Let me ask you, do any of these data points suggest tomorrow could be an upside surprise on jobs?
Yeah, well, I'm not going to be surprised on the upside. I think people are far too moved, by short-term fluctuations. I'm betting we're seeing 160, 165 tomorrow. Probably the unemployment rate will stay at about 8.2. People overestimated the weakness of the economy in the spring, just as they overestimated the strength in the winter. The basic story was we had a better than normal, better than trend, I should say, story December, January, February because of the unusually good weather. But that meant we didn't get the ordinary spring hiring we would see, and now we're getting back to trend, and that's around 160, 170,000 jobs a month. Not great, but not a disaster.
All right, so Dave Goldman, I've got a bid here of 160 to 165,000. I think the consensus is 100 to 125,000. What do you think? Is Dean Baker right? Is the consensus right? Or are you below everything?
I'm below everything, Larry. The one decisive thing in this picture is that we have the worst investment outlook in the post-war period. No exceptions. We're still 10% below the last peak in capital investment. As a supply sider, I say no investment, no jobs, no spending. And that's why every number we've gotten this week has disappointed us decisively on the downside. There are just no sources of strength. The consumer is tapped out. We saw very low borrowing last month. The personal savings rate is too low. Exports are tapped out. But that investment picture, which I see as conditioned by the worst tax increase in American history, Obamacare, and other regulatory uncertainty, has just kept investors putting their money under the mattress.
All right, Dave, Dean Baker, you heard Dave Goldman. Higher taxes, higher regulations, higher Obamacare spells lower investment, lower jobs.
Yeah, I think he's reading the talking points and not looking at the data. I'm looking at the data that Commerce Department's putting out. We had a big uptick in construction. The private side, public sector construction was down in May. Big jump in private sector, residential and non-residential. Also, we got data on durable goods orders, new capital goods. That was a big uptick. It was about 1.5% in May, with and without aircraft orders.
Yes,
I see a lot of good numbers here. I'm not reading the talking points. I'm looking at the data.
If you look at the data carefully, most of the durable goods orders are going to export. The actual consumption of capital goods by American companies is way below the peak. It corresponds exactly to the miserable GDP numbers on non-residential private fixed investment. In real terms, 10% below where we were in 2007.
That's because we ended you didn't hear about the housing bubble. We ended the housing bubble. We ended a housing bubble that led to record levels of construction.
I'm talking excluding housing. I'm talking strictly non-residential, and I've tracked all the export and import numbers in capital goods to try to get an idea of how much capital we're actually consuming, and the answer is it's extremely low, worse than the post-war period, pure air pocket in terms of animal spirits.
I could show you different data there. Equipment and software share of GDP is just about back to its George W. Bush level. You might want to attack him, but, we're just about back to where we were before the downturn began, and given how steep a downturn that was, I think that's pretty good. We have a lot of the economy that have a huge amount of excess capacity,
but Dean
so that's
Baker,
pretty striking.
We had this ISM manufacturing report, and inside that report was a huge deflation of prices. And, Dean, I worry about deflation. In fact, I worry about worldwide deflation. In fact, I worry about global recession. I'm not quite there yet, but I'm worried about it. If any of that stuff is remotely true, we're going to see it in tomorrow's jobs number.
Larry, last time I've been on your show, you've been worrying about inflation. You got to make up your mind, one or the other. We can't have both.
I'm worried about. I've been watching deflation for the last 2 or 3 months, man.
No,
that's
we're seeing a fall in material goods prices. I've been on your show last time. You were worried about high oil prices. Come on, it's got to be one way or the other. Both of them can't be a problem.
Well, which is it? Which is it, though? Dave Goldman,
we're seeing a fall in some commodity prices because we have weak growth around the world.
Right.
It's not the U.S. determining a world market in oil. We see a slowdown in China, a slowdown in Latin America, slowdown in Europe. You're going to blame that on President Obama?
This is precise. Well, we have a weakness in export orders. For example, we had a big kick from China during 2011, pure stagnation in exports to China during 2012. That'll probably improve as the Chinese stimulus kicks in. But the decisive thing, which is the overall GDP commitment of non-residential private fixed investment, is worse than at any time in the post-war period. We've never been 10% below the peak 5 years afterwards. That's Obama.
All I'll say is, Dean Baker, in the last 90 days, I have seen a lot of signs, and I call them as I see them. I'm telling you, there's deflationary signs. Go back and look at the charts.
You can bring me on next week to laugh if it's a bad number tomorrow.
All right, we'll see.